While I do that, I'll tell you a little bit about myself. So I am an attorney, and I have a boutique corporate law firm here in San Francisco. And we work with, we work with a lot of VC funds and startups doing equity financing rounds. And then we also do M&A as well. And our practice is sort of split 50-50. So hopefully you all can see my screen there. Let me see. Is that working or? No, it doesn't look like it's working. Maybe it is working. Can people see the slides? You can? Great. Okay, thank you, Nick. Okay. Yeah, so like I was saying, as a corporate attorney, and I work on a lot of equity financing rounds and M&A transactions and doing general corporate and commercial work. A lot of our clients are startups and founders. And I find that this presentation is helpful for startups because even though I've gone through the due diligence process literally thousands of times at this point, I appreciate that not everyone else has. And sometimes, folks can get frustrated and, not understanding what's required and why are investors asking all these questions and all these kind of things. So I found this presentation can be helpful as sort of a, education just to like what it's, back to basics. What is due diligence? What's it about? What's required? What's going to be expected? This presentation is focused towards equity financing rounds for early stage companies. I'm looking at it from the perspective of the founders and also from the investors. Sometimes investors need a little bit of a steer on how to do their due diligence correctly as well. And with that, I'll kick off. On this slide here, this is what we're going to cover today. We're going to go through, what is due diligence and why it matters. We're going to spend a lot of the time talking about due diligence checklists and the items that you need to provide during due diligence. Or provide if you're a founder, or review if you're a investor. And we're going to look at through the various checklists. Then we're going to talk about founder best practices and then investor best practices, and hopefully give founders some insight into the investors' perspectives. We're going to go over some red flags that can kill deals and Q&A. I will add though, feel free to pop questions in the chat as you're going along. It can sometimes make it a bit more engaging if you add in your questions, while I'm rambling to help break it up a little bit. So feel free to pop any questions in the chat, or we can save them up for the end as well. Either's fine. Okay, so here we are. What is due diligence? So due diligence in the equity financing perspective, and due diligence is done on other transactions as well. But generally speaking, it's the investors reviewing your company to make sure that, your T's are crossed, your I's are dotted before they give you the money. And usually, you'll meet an investor, you'll pitch them, you'll get to the point where they want to sign a term sheet with you. They may have done a little bit of preliminary due diligence just quietly before they sign that term sheet with you. But once they sign that term sheet, that's when the due diligence starts in earnest. And usually the investors will send over their checklist of the things they want to review, and they'll want to get all the review done. And if there's any issues, they want to get them all fixed before the round closes, before they give you the money. So that's usually when the due diligence happens. It's usually a 2 to 4 week process. If you're a super early stage company, it can be very quick because it's just a matter of you've only got a handful of things that they can look at. Or if you've been around for a while and it's your Series A round or something like that, the due diligence can be more thorough and the checklist longer. And just know that while you're going through the due diligence process, the findings that the investors pull up during the due diligence process, it can impact on the investors wanting to go back and look at the terms in the term sheet again, or, while you're negotiating the investment deal docs, they might want to modify some terms in there based on what they found in due diligence. It could, have the investors could revisit their valuation from things they turn up in due diligence. And then sometimes things come up in due diligence and they can't be fixed, and the investor can't be made comfortable, and the deal just will go away. So, there's sort of a range of how this process can go. So, being educated up front, working with your legal counsel, having your ducks in a row, that makes a huge difference. On this slide, we have a little general overview of the types of transactions that require due diligence. Like I said, today we're going to focus on early stage equity financing rounds and the due diligence that typically happens with those financings. So we're talking about safes, convertible notes, preferred stock rounds. In all those types of financings, there's likely going to be some level of investor due diligence of your company. Some other transactions where DD comes up, bank loans. If you're getting a loan from a bank, the bank or the lender will probably want to do some due diligence on the borrower, just to, have a sense of how stable that loan will be, whether it'll get repaid and so on. And M&A transactions, there's a lot of due diligence. If you're selling your company, you should expect that the buyer is going to want to do a lengthy due diligence review of your company. And similarly, they do it between, the term sheet, the letter of intent stage, and while you're negotiating the definitive transaction documents. Now, buyers will do a lot of due diligence, and sometimes if you have a seller who's receiving stock as the purchase price, so say you've got a buyer who's paying the seller in stock, their stock, in those types of deals, the sellers will sometimes want to do due diligence on the buyer. They're like, all right, you're going to pay me in stock, okay, but I want to know a bit about your company. So there can be sort of reverse due diligence in M&A transactions as well. And then finally here, some major commercial contracts, the parties can do due diligence on each other. These are sort of large strategic type contracts and arrangements. That's when there might be some DD going on. And like we said before, over the course of the due diligence, it might result in some terms being modified or renegotiated. The valuation might be revisited, or if there's a really serious issue and it can't be fixed, sometimes it can result in the deal going away. Okay, so now I'm going to get started on the checklists. And I should say, if anyone would like a copy of these slides later, feel free. I'll share my email at some point, and feel free to email me and I can send you a copy of the slides. But just kicking off here, when I'm doing an equity financing and I'm representing an investor, this is typically what that due diligence checklist will look like for an early stage financing. So, your pre-seed round, your seed rounds, your Series A. When people are investing, say, 5 million or less, this is a typical list that I would send for the legal due diligence. And keep in mind that the investors they'll do a legal due diligence, but they might also want to do a financial due diligence and perhaps a technical due diligence too. So on the legal front, the first thing I ask for is the cap table, and this is really important. It's really important that for startups, for founders, you keep a very clear cap table that includes all the common stock, who the shareholders are, how much stock they hold, what class they are. Usually it's just common stock for early stage companies, but you want to set all that out very clearly. If you have a stock option plan or a equity incentive plan, you want to include that in the cap table. If you've made option grants subject to that stock option plan, you'll want to have a ledger listing out all the options that have been granted. Similarly, you want to have a ledger setting forth if you have any safes or any convertible notes. You just want to keep it all in the cap table and you want to have it correct. It's very important, and it's an issue I see come up time and time again in due diligence. People not taking their cap table seriously, and it can cause serious problems. And I guess one thing to sort of flag, to sort of keep in mind, is that often when investors are looking at you, they're looking at, 5 other companies that are doing something similar. So, and, usually they'll go with the company that they think has the best chance of succeeding. But, if they're looking at 5 companies that are essentially the same, and there's one company that's just their cap table is a mess, that can be sort of an easy way for them to pass. So, don't get caught in that trap. There are like cap table management services out there if you don't think you can manage it internally, like Carter or Pulley, and there's new ones popping up here and there all the time. If you need a recommendation, feel free to reach out to me. Okay, sorry for my little cap table rant, but it comes up all the time. So the next thing I will say is the constitutional documents. If you have a corporation set up, we want to see the certificate of incorporation, the bylaws. If you have any consents from your board, from your stockholders, just send those all over. Investors will want to review all those for early stage companies. If the founder is subject to vesting, is it on the standard 25% on the 1-year cliff and then 3 years monthly, so 4 years overall vesting? Is there single trigger or double trigger acceleration? All those terms investors will want to know, and usually that's going to be captured in a restricted stock purchase agreement. So include those things in your data room. I mentioned above, but ESOPs, stock option plans, equity incentive plans, investors will want to know, do you have them in place already, or do you have the pool allocated, because you have to allocate a portion of stock to the pool, or if not, do you have a plan to implement a stock option plan? You don't necessarily have to have one, but it's just good to have an idea to tell the investors, what you're thinking about in terms of incentivizing your employees. If you do have a stock option plan in place already, and you've already made some option grants, the investors are going to want to see the 409A valuations. And that's the valuations that set the fair market value of the company's stock, which is how you price the exercise price for the options. So that can get a little bit technical. Just keep in mind that work with your lawyer to put your stock option plan in place and comply with the rules. And when the due diligence time comes, you'll have it all nicely in order for the investor to just quickly check and, cross that off their list. Okay, the next thing here, if you've done a previous financing round, if you've done a round of safes, or you've already done a preferred stock round, whatever it may be, include those financing, the closing binders for those financing rounds in the data room. I just make a little note here about the QSBS attestations. If you have gone through that process on one of your preferred stock rounds, include that in the data room. That can just be helpful for the investors to know. The investors and all shareholders, care about QSBS. If you have any shareholder agreements, side letters, voting agreements, any types of corporate agreements out there, include those in the data room. If there's something particularly confidential in one of your side letters or something like that, talk to your lawyer about including in the data room. But generally speaking, you should share all those documents. And if there's any litigation, if the company's got caught up in litigation somehow, or a government investigation, or say an employee's made it, left on bad terms and made a complaint against the company, something like that, best to disclose those types of things. You can include a short summary in the data room. You don't necessarily have to include all the, court documents or what have you, but you should at least include like a 1-pager summarizing what's going on. And then they can ask you for more information if they need it. Okay, so that's a general overview of the legal checklist that I ask for most early stage company financings, equity financings. Now, these are not legal items, but these are other due diligences that your investors may want to carry out on startups. From the commercial perspective, they'll probably want to know who your key customers are, whether you have them or who you're going to outreach to in your sales program, who are your suppliers, who are your vendors, where's your revenue coming from, where do you project your revenue is going to come from. They might sometimes involve the lawyers and ask us to look at some of the key customer contracts, but generally they'll just want to talk to you about that early on. And then on the financials, mostly for early stage companies, investors want to know that you're taking your financials seriously. So that you've got a habit of keeping proper financial records, you're using QuickBooks or what have you, and that you're able to produce, P&Ls and balance statements and all those types of things. They'll want to know about your burn rate, and they'll want to know about your projections. What are you going to do with the money that they're giving you, essentially? All right, I'll quickly pause, have a sip of water. If anyone's got any questions, just pop them in the chat and I'll take a look. Okay, I'll keep plowing on. Oh, there we are, regulatory. Okay. So another piece of the due diligence. Oh, okay, there's a question. Oh, there's a bunch of questions. Sorry, I didn't see them there. Okay. Sorry, everyone. I'll quickly look through these now. Okay. Yes, great. You can see my slides. I will happily share a copy of the slides. Just send me an email and I'll share my email later for you. Okay, and I believe there will be a recording as well, and they'll put it up on YouTube. So I'm happy to share that with you as well. Oh, yeah, good point about the next slide. I'm sorry, I'm the tech lawyer who's like not tech savvy, so I'll see if I can fix that. Apologies about that. And Chia, for your question, I would say, I'll ramble through all this topic as much as I can fit in the hour today. If you have follow-up questions, please don't hesitate to reach out to me. I'm happy to set up a time to talk further on all these topics if you like. There, an answer to your other questions, there is a bunch of other cap table services other than Carta. Another one's called Pulley. I know that Fidelity, like the benefits group, they are offering a free cap table management services, but I guess they're trying to sell you other products. But anyway, that's a new sort of product that they're putting out. So there's Fidelity, and I think JP Morgan might be doing something similar through their startups base. But yeah, feel free to reach out to me and I can share some names for cap table management services. Data privacy, great question. I have a slide that I touch on that later, so I'll talk about that in a little bit. Okay, do investors ask for tax returns? Yeah, so that's like another, that's one of those ones that they may ask for it and you may or may not feel comfortable sharing it. I talk about this a bit more later on in the presentation, but as you're going through, due diligence review and you're building your data room, there's certain things that is totally fine for investors to ask for, the list of things that I put up early on. That's all perfectly reasonable. It's reasonable to ask for some financial statements. Now, your tax returns, that's kind of getting into the weeds a little bit. If someone's investing, 100K in you or 500K, from my perspective, you don't have to hand over all of your, top secret information, but it's a sort of an assessment that you need to make as you're going through the process. And I will talk some more about that as we keep going. Okay, I think I got the questions. Please feel free to just give me a shout out if I'm missing them as we're going along. And let's see if I can get rid of this extra slide here just quickly. Maybe that's better. Does that seem better? off one. Oh, here we are. Okay, great. All right, so regulatory. So a little bit to my point just then, with early stage companies, a lot of investors don't expect you to have your whole regulatory compliance regime in place straight away. But they'll generally want you to be aware of what regulations you will be subject to, and what those risks are, and how policy changes can affect your industry, your market, and how you're going to be able to adapt if you need to, if there's a significant change in the regulatory regime. And what regulations affect you will really depend on your particular business. So there's no sort of one size fits all here. This is just something you're going to have to work through with various different advisors as you get your business up and running. I made a list here of some of the sort of common ones that I see. But if you're, environmental, if you're doing something that involves, real property or manufacturing or something in the climate space, there's a good chance you're touching on some environmental regs. Permits, if you've got a lease or some, again, some real property, you may need to have permits to do whatever you're doing. If you're doing a climate startup, there may be some carbon credit certifications or other types of certificates or benefits that may be available to you in various regulatory regimes. Safety issues can come up if you've got any manufacturing or something sort of in the hardware space. Grants can often be important if you take some non-equity financing in the form of grants from the government or from a non-profit organization. You're going to need to comply with the terms of the grant and so on. Privacy, data protections, they impact most businesses. Cyber risk is a huge risk. What are you doing to protect personal information of your customers, employees, and so on? If you're doing something in medical device space or something similar, FDA, clinical trials, Department of Energy comes up for climate startups. Just generally speaking, there's the federal regulations, obviously, which I've sort of mostly been speaking to, but you're also going to have state regulations and you're going to have local regulations. So check with your city regulations as well. Sanctions, Foreign Corrupt Practices Act, they can be important depending on your type of business. Tariffs affecting more and more people, and then CFIUS goes to foreign ownership. So there's just a brief overview of a few regulatory regimes that I see come up on a pretty common basis, but there's lots of others as well. It really depends on your type of business and the industry you're in. Again, it's probably not going to be a big part of your due diligence review for an early stage company, but just something that you need to be aware of and speak to if you're with your investors. And certain investors will care about this more than others. Okay, IP. So IP is an important part of the due diligence that I do when I'm working with investors and on the company side too, helping people prepare. But this is an important piece for tech startups. And, on one side of the slide here, I've got listed the sort of registered IP, which is somewhat important. But what is the most important for early stage companies is having these IP assignment agreements in place. So that means your confidential information and invention assignment agreements, or proprietary information and invention assignment agreements. Usually these are standalone agreements that you want everyone on your team to sign. So you want the founders to sign it, all your employees, all your consultants, everybody signs a version of this agreement that says anything they work on for the company is owned by the company, essentially. And usually for early stage companies, that's, sufficient to protect the company's IP. So I would just say, make sure that for the startups and the founders on the call here, just make sure you have a policy of putting these in place as you onboard folks. A lot of investors will want to see all of them as part of the due diligence process. Sometimes those terms are included in employment agreements, but standalone agreements are common too. So on the other side here, a lot of early stage companies don't have patents yet. They may not have registered their trademark or any copyrights, and that's fine. To the extent you do have them, you can include that information in your data room. If you don't have them, that's fine. You can just say you don't have them. Don't include any trade secrets in your data room, and don't include any source code in the data room. And be hesitant on, what you reveal about your technology stack. I would say don't include anything unless it's asked for, and if it is asked for, work with your lawyer or your team to just work out what can be shared and what shouldn't be shared. Don't immediately just share it because they asked for it. And I wouldn't offer it unless they ask for it as well. Okay. Now I'll just see if I can figure out sorry, not meaning to skip the, just seeing if I can see if there's any questions here. Oh, there we are. Looking in the chat again. Okay, is it best to have digital or physical copies of everything or both? Great question. I would recommend that you have a digital data room and you set it up straight after getting incorporated. So you've got the data room set up, like use Google Docs or Box or Dropbox. There's a whole range of online data room providers. And as soon as you're incorporated, start dropping documents in the data room that will help you respond to that checklist when the time comes. So when you get that term sheet, you've got the data room ready to share. Now, to that end, you need to make sure you've got that data room secure. So make sure you're using a professional provider that can secure the data room and put a password on it or what have you, but make sure your data room is secure. And online is best. Okay, when using vibe coding and coding generation techniques, who owns the code entirely? That's a really good question, and it's one that's been coming up a lot. And you need to carefully look at the the terms of service of whichever provider you're using to do the vibe coding. I think most of the ones I've looked at do say that you do own what you generate through that platform, but you want to carefully check the terms of service for any vibe coding, ChatGPT and whatever LLM provider that you're using to do that vibe coding. And to that end, you should have a copy of the service agreement for that, for that vibe coding service in the data room, or link to the terms of service if you just did a click through sort of terms of service. They'll want to look at that typically. Okay. What's the next question? What if they scheduled a live 90-minute meeting for technical deep dive? Well, Himke, I think that's a good sign. If that's been scheduled, that means they're really investing in the due diligence review. And, I think if you've got to the stage where they want to do that, you guys should circle up with your technical team, before you jump on that call and just talk about what you're happy to share and show. And, sometimes showing something is a more secure way than just giving them access and allowing them to poke around. So when it comes to that sort of technical due diligence, I think it's a really good sign if they want to do that. But yeah, maybe just be careful on what you share, how much access you give. And maybe you're comfortable with giving access. I mean, they'll want to have a good sense that what you're building is real and that you know what you're doing. So it's about finding that balance. But yeah, I would say just prepare as a team for like what you're comfortable sharing, and reputable VCs aren't gonna, steal tech. Well, they shouldn't, but so yeah, feel free to reach out to me to talk more about that if that's helpful. Are patents worth the cost? Yeah, I heard conflicting things too, Nick, on that. And it's really a business by business decision. Obviously, when you put in a patent, all that information becomes public eventually. And do you want that information to be public? Because then it can be copied. And obviously, with the patent, you have the right then to pursue and send a cease and desist letter and sue if people use your patented technology, but you've got to find the breach. So people might use it and you might not be aware of it. So that's worth a presentation on its own, I think. But it's really, a lot of businesses do think it's worth it, especially when you're coming to M&A, looking for an exit. Having a portfolio of patents can be really valuable. But there's other reasons that they're not a perfect asset either. For Chia's question, should we follow something like your checklist, or investors have their own checklists? So you follow the investors' checklist, whatever they ask you to provide, that's where you start from. If you get a list and it just seems crazy, like someone's investing 100K and they've sent you like a 20-page checklist, maybe just take a pause and discuss it with a lawyer. But usually for early stage investments, there'll be a short checklist very similar to the one I shared earlier on. That's very market standard. Yeah, I think that's a fair comment. Walid says that personal returns are your personal matter, but corporate returns are fair game. That's probably fair enough. I mean, I probably would be inclined to share, your P&Ls and your balance statements rather than your company's tax returns, but there may not be any particularly revelatory information in your tax returns, and you may feel fine sharing those. So, okay, now try and get back. There we are. Okay, we're back on the slides now. Okay, now did I do the last slide? Oh, my mouse is going funny, but let's see here. Oh, sorry, back here again. Oh, yeah. Okay, we talked about that. All right, sorry. Okay. Here's just a little final checklist just for some sort of final things to think about that come up in due diligence. Regulatory we've touched on, but are there any license permits that might be relevant to your business? Pop information about those in the data room. And if you're not comfortable sharing the exact permits and licenses, you can always include like a one-page summary, and then investors can dig deeper if they want to. Same with legal. If there is some litigation or you've had some threats of litigation, you can always just include a summary of what those are, and the investor can follow up if it's of particular concern to them. Tax, like with financials, they'll just want to know that you're properly preparing tax returns and that you're on it. You're not just ignoring tax. Insurance. Now, for startups, maybe it doesn't make sense to get insurance if you can't afford it. But if you can, you're going to want to have a look at sort of general liability insurance. Cyber insurance can be really important. Directors and officers insurance, also important. And then sometimes some VC funds, especially the big funds, they'll run background checks on the founders and key employees, just so they're aware of like who they're getting into business with. Okay, this is a bit more of an administrative slide, but you're getting to the end of the due diligence. You'll want to have your bank account ready to go. Hopefully you've already got that set up. Send along your wire information to the investor in a secure way. Sometimes like just a PDF people feel fine with that. And then you should encourage the investor to do a wire callback just to make sure that the correct person has your information and so on, and mostly it's to protect the investor, but they don't wire to the wrong person. When you incorporated your entity, you should have set the registered agent then. It's not a big deal, but just it can be helpful to just make sure you got your registered agent sorted out. And sometimes investors will ask for a good standing certificate from the state where you're incorporated. They don't always ask for those, but sometimes they do. And that just shows that you're up to date in your state in terms of like paying your franchise taxes and doing your annual reports and so on, which is just a good practice to be in. Okay, best practices for founders. As we already touched on, you want to be prepared. Get that data room set up early. Ideally, have it set up before you get the term sheet, so you're not preparing it while you're trying to negotiate the investor docs and deal with all the other things in the financing round. That said, most people, of course, leave it till they've got the term sheet, but that's okay too. But yeah, just I would advise to set it up as early as you can. Have it nicely organized. Use one of those professional platforms. Dropbox, Box, Carter can be helpful here too. Google Docs. And have your documents in folders so it's easy for investors to find and connect it to the checklist that they sent to you. You'll want to keep it current. So, I would advise as soon as you're incorporated, set up an online data room and drop documents in there as you're going along. Maybe make a little calendar invite once a quarter to update your data room. Include, after a major event or a big sale, you might want to put that customer contract in there or something. Keep it accurate and up to date. Now, as we also touched on before, security is really important. This is your confidential information. You don't want just anyone getting access to it. Include a password, track who accesses it, use one of these professional platforms, and limit the sensitive information. So one thing to think about, if you do the approach that I suggest, where you set up the data room shortly after incorporation and you just drop documents in there as you go along, you might want to just do a little bit of a cleaning exercise before you give investors access to the data room, just to make sure that you don't have anything in there that's overly sensitive that they haven't asked for or they don't need to see. And as I've noted here, don't include trade secrets or source code in there or overly sensitive data. You obviously want to be transparent and tell them what you've got going on with your company, but you don't need to share, how the sausage is made, for want of a better phrase. And yeah, make sure it's secured. Okay, a little chat about NDAs here. So I typically tell my startup and founder clients to not ask for NDAs from VCs, particularly, professional VC funds. These guys are looking at thousands of companies. They're not going to have time to have a look at your NDA, and it just gets you put to the bottom of the pile. So if you're dealing with a VC that has a reputation, it's generally okay to share those, that initial due diligence with them without having them sign an NDA. Now, that said, there are exceptions here. If you're dealing with an investor that has a clear conflict of interest, say it's a VC that has already invested in 5 companies that are the same as your company. Well, maybe in that instance, you might not want them digging around in your data room without some protection. Similarly, if say it's a corporate VC, they could be a really great match for you. Corporate VCs can open a lot of doors for customers, or they may end up acquiring you. But 9 times out of 10, that corporate VC is going to be practicing in the have their business in the same industry as you. So you probably want to be a bit more conscious of having an NDA in place with a corporate VC, and they'll probably want one with you as well. So a mutual NDA in that situation can be good. And, you know, maybe you start out the due diligence, you don't have an NDA, but then they want to do that 90-minute technical session, or there's something else, you know, some more sensitive information comes up that they want to take a look at. Maybe at that point you take a pause and say, do you guys mind signing an NDA? And proceed that way. But just know you generally don't need them, because VCs, you know, they've got reputations to maintain, and if they get a reputation of sharing confidential information, they will, you know, not get offered all the deals that they want. So, okay, on the flip side, some best practices for investors. You know, if you're an investor, have your checklist ready to go as soon as you sign the term sheet. Sign the term sheet, don't mess around, send the checklist over. Customize your checklist for what stage. You know, if it's a seed stage, you're going to have a different checklist for the Series A. If you're writing a small check versus a big check, that due diligence list should reflect that. And set timelines for the company. You know, tell them you want this information within a week, within 2 weeks, so you've got time to review it and so on. Clearly communicate, you know, your expectations to the startup, so they know that this is important and they need to get it done. I would say do the due diligence at the same time you're negotiating the investment documents. Do the process in parallel so you can move as efficiently as possible. And also, I would say focus on the material issues. You don't need to go down to, you know, down every rabbit hole, look into all the nitty-gritty for early stage companies. Just focus on what's material and important to you. And if you're an investor, keep in mind that pre-funding is the best time to fix any issues that come up in due diligence. Once the startup has your money, they're going to be focused on deploying that capital. They're going to be distracted, and they're not necessarily going to focus on getting, you know, the items identified in due diligence done. So I would say insist on getting them done prior to closing. Okay, and be helpful to founders, you know, if there's problems, help them figure out a way to address those gaps. Okay, quick sip of water here. Right. Here's just some things to keep in mind. I know I've got the big scary red letters, deal breakers. Just know that sometimes these are deal breakers and sometimes they're not. So often things are fixable, despite my dramatic language here. The first point about founders' disputes, that goes right back to the cap table that I talked about at the start. Have it clear in the cap table what founders own in terms of equity, because that's where 90% of arguments come from. You know, founders misunderstood how much of the company they own. They misunderstood if they were subject to vesting. One founder's doing 90% of the work, but only has 30% equity. And, you know, that's sort of the root of like all disputes. So make sure you have that cap table clear up front so everybody knows who owns what of the equity. Those IP agreements, they're not really deal breakers because usually you can get them. So if you don't have them, you can usually go around and get everyone to sign one. Where it can be a problem is if you've had a founder who's left and perhaps they didn't leave in great, you know, on great terms, and then that can be a problem. So you've got to go get an IP assignment off someone who, you know, might be in a bad mood with you. They might refuse to sign it. So that's why it's important as part of your onboarding process, just have everyone sign, you know, PIIAA or CIIAA. If you have litigation or you're subject to a government investigation, just disclose it. If they find out later, that's going to be a world of pain. So yeah, you don't necessarily have to disclose every detail about it, but you know, like I said, you can either put the documents in the data room or you can put some sort of summary of the situation in the data room. But yeah, do disclose litigation or regulatory issues like a government investigation or something like that. If you've I mean inflated projections, you know, who doesn't have inflated projections, but you know, make sure your projections are based on real numbers or some data to back them up. Don't hide your burn rate. Be truthful about that information. That can really come back to bite you if you're not truthful about those things. And if you have, all your customers, are highly concentrated, that can be a bit of concern. It's not necessarily a deal breaker, even though I've got it up there, but, just know that that is going to be sort of an issue of concern. And depending on the industry, it may be of greater concern. Some industries you can't help but have concentrated customers. So that's just something that may come up in due diligence that could be really important to your investor. And then some yellow flags, if your corporate records are incomplete, you want to get on top of correcting those. You don't necessarily need an employment agreement with everyone, but certain key employees you might. So sometimes investors insist on having employment agreements in place. The ESOP, different investors have different opinions on this. Usually they do want to see one in place, that you've got a stock option plan in place. You have a plan to incentivize your team when the time comes. And that you've done all that correctly. There is a lot of compliance around doing stock options, so just work with your attorneys on that to make sure you're doing it correctly. Okay, and if there's any sort of significant regulatory gaps that you're not complying with, that you should be on top of, that's something they will want you to correct before closing. Okay, here's our key takeaways. I'll do a quick, actually, I'll go through this slide and then I'll pause and look through the questions. Okay, key takeaways for founders: prepare early, get that data room set up, as soon as you can. Keep the data room nice and organized. Be transparent and build trust. Transparency and trust go hand in hand. For investors, be efficient. Focus on the material issues. Don't go down every rabbit hole. Be helpful. Try and help the startups fix the problems that they identify. Most problems are fixable. It's very few that aren't. Keep the momentum going. Don't let the deal stall out over due diligence. And for everyone, keep in mind that the due diligence process is a way to build trust between the company and the investor. It will set you up for success. The due diligence is for a good reason. It's to help your company be operating the best way it can. So to the extent that investors ask you to correct things, know that it's for your success. Transparency wins the day and preparation pays off. All right, and there's my contact details.